On this episode of China Uncensored, why Alibaba might be a risky investment. Hi, welcome to China Uncensored. I'm your host, Chris Chappell. You might have heard lately about the Chinese e-commerce company Alibaba. Think of it as a giant combination of Amazon, eBay, and PayPal. Last week, it had the biggest IPO in the history of the New York Stock Exchange, raising $25 billion. On its first day of trading, Alibaba's stock prices shot up almost 40%. By the end of the day, its market value exceeded $240 billion, making it the second largest internet company and making its founder Jack Ma the richest person in China. So Alibaba seems like a great investment, right? But like almost everything else involving China, say it with me now, it's complicated. You see, the problem is when you buy shares of Alibaba, you aren't actually buying Alibaba. It's illegal in China for foreign investors to own controlling interests in Chinese companies that operate in certain industries. These are industries that the Chinese authorities considered sensitive, including internet companies like Alibaba. In Alibaba's own IPO filing to the U.S. Securities and Exchange Commission, it said foreign investors are generally not permitted to own more than 50% of the equity interest in a value-added telecommunications service provider. That's under a section called Risk Factors. What that basically means is that it's illegal in China for Alibaba to sell shares on a U.S. stock exchange. What? So how do they get around this? By not selling the Chinese company at all. When you buy shares of Alibaba, you're actually buying shares of a variable interest entity, or VIE, called Alibaba Group Holding Limited, which is a shell corporation registered in the Cayman Islands. This shell corporation has contracts with the actual Chinese company Alibaba that entitle it to the company's profits. Think of it like this. Let's say I open up a lemonade stand in China. You're in the US and you want to buy half of my lemonade stand. I'd love to sell it to you, but lemons are too sensitive in China, so it's illegal. Instead, I'm going to sell you this amazing picture of my lemonade stand, plus a contract that gives you half the profits from my lemonade stand. Everything works out, right? Until one day when the Communist Party decides that selling pictures of lemonade stands is also illegal. The contract now means nothing, and you've lost all your money. Ouch. Of course, the real structure of the Alibaba Shell Corporation, or actually corporations, is much more complicated than my lemonade stand. Take a look at this. Under the main VIE holding company in the Cayman Islands, that's the one you're actually investing in, there are several other holding companies in the Cayman Islands, the British Virgin Islands, and Hong Kong. That's before you get to the actual companies registered and operating in China. So essentially, this string of dummy corporations has been set up to get money from foreign investors to the actual real company, since it's illegal for foreign investors to have a direct share ownership of a Chinese company in these certain industries. It's a trick. To Chinese regulators, it's a Chinese-owned business. To foreign investors, it's a foreign-owned business. What could go wrong? Well, according to legal experts, it's unclear if this is actually legal in China. It's one of those gray areas where there are technically no laws against VIEs, but they could violate certain interpretations of the law or regulations against foreign ownership of these companies. At some point in the future, the party could decide to make a new law or regulation, or change their interpretation of current laws, and instantly, all that foreign investment goes up in smoke. Again, in Alibaba's own SEC form, it bluntly lays out the risks of VIEs. Alibaba isn't the only company to do this. Every Chinese internet company listed in the US has the same VIE structure, including Baidu, NetEase, and Weibo. These contracts between the VIEs and the Chinese companies are only valid if they hold up in Chinese courts. And this whole thing is based on circumventing regulations established by the Chinese regime. And remember, this all depends on the assumption that China maintains a rule of law to begin with, which it most definitely doesn't. And that's another risk foreign investors face. The Chinese company on the other end of the VIE could just choose to throw the law out the window and steal all the money. To address that, the foreign-owned company would have one option: sue the VIE to enforce the legal contracts. However, that would only work if the Chinese judges decide to honor the contracts. Now, something like this has never happened, and it's not likely it would happen, as the major Chinese companies listed in the US have a vested interest in remaining trustworthy to investors. But again, the point is that if anything went wrong, investors would have to depend on the Chinese legal system to sort it out. To give you an idea of how things could change suddenly, Yahoo was Alibaba's first major foreign investor. Part of Alibaba at the time was an online payment tool called Alipay, basically a PayPal kind of thing. In 2010, without notifying Yahoo, Alibaba spun off Alipay into a separate company owned solely by Jack Ma. So Alipay, which was created from Alibaba resources, which was backed by foreign investors, didn't make those foreign investors anything at first. Alibaba said they had to do this because of new regulations from China's central bank on licenses for online payment systems, which at the time were only issued for domestic Chinese companies. Although Yahoo and other investors were eventually compensated for the change, it caused a lot of distrust. Look, I'm not hating on Alibaba. They're just playing the game. Alibaba built its entire business on being unusually transparent for a Chinese company, which it had to in order to gain the trust of Chinese consumers in a country that has massive problems with fraud and counterfeiting. The real source of the problem is the Communist Party. They're so obsessed with total control, they put into place these restrictions that are then only selectively enforced based on the whims of officials. China, no matter how they try to spin it, is not a capitalist country. And let's remember as well that with all things related to the party, political patronage matters. For example, Jack Ma traveled with Xi Jinping to South Korea recently. Some of the domestic investors in Alibaba include firms operated by the children of former Chinese leaders like Wen Jiabao and Jiang Zemin. So far, Jack Ma has been playing his cards right, but with the current factional struggle, things could change quickly. Just ask Xu Ming, head of the Dalian Shida Group and at one time the 8th richest man in China. He made a lot of money getting close to former Chinese official Bo Xilai, until he was arrested as part of the party's takedown of Bo Xilai, forced to testify that he had bribed Bo, and now may face charges himself. You've got to choose your political patrons wisely. And here's one more thing to consider about companies like Alibaba. You may not be investing directly in Alibaba yourself, but you could still be affected if anything drastic happens with the company. That's because the biggest shares of Alibaba went to institutional investors like mutual funds. So if you own mutual funds from Fidelity Investments, for example, you might have some Alibaba shares in there. Of course, mutual funds are designed to minimize risk by spreading out their investments, so you probably don't have to worry too much. What do you think about Alibaba and other variable interest entities? Leave your comments below, like us on Facebook, and subscribe for your share in Lemon's Uncensored Lemonade. Thanks for watching.